Good morning, everybody. Welcome to the day 5 of the national level workshop on research methodology and data analysis. Hope you've had a nice learning all these 4 days. And of course, to add to that, today I'm delighted to present and introduce another esteemed colleague of ours, Dr. Rajveer Samuel Rollin. Dr. Rajveer Samuel Rollin. Sir is a dynamic professional with 20+ years of experience covering teaching, corporate training, investment advisory, student mentoring, risk management, portfolio management, research, hedge fund accounting, asset management. Sir also has teaching and research expertise involving key areas of finance. Sir is proficient in financial research and analysis, use of key statistical packages like SPSS, GRETL, and others. He possesses excellent communication skills with exceptional relationship management in mentoring and developing students. Sir possesses sound knowledge about a wide range of financial asset classes. Sir is proficient at developing apt financial solutions for clients, providing investment and advisory and alternatives for ensuring maximum ROI. Sir is well versed with technical analysis, tools and systems, financial data streams like Bloomberg and others. Sir has authored 14 journal articles and 5 books. He's an accredited management teacher from ARIMA and an entrepreneurial/financial teacher from NEN, National Entrepreneurship Network. Sir is basically a BTech in chemical engineering, followed by an MBA in finance and a PhD in finance from Bharatiya University. Sir has been working as assistant professor in the Department of Finance at MS Ramayana Management since 2016 onwards. And prior to working with MSRIM, Sir has worked with ABBS, Acharya Bangalore Business School, Dayanand Sagar College of Engineering, Great Lakes Institute of Management, Chennai. Sir has worked as a financial analyst in Kevin Care Private Limited and also has been an accounts manager in VECM capital markets. He's also been an independent commodities trader and such. Sir has more than 20+ years of experience in the financial domain. He is a practitioner, teacher, researcher, mentor, all things put together. So I will leave the session to you. And
okay. Good morning, everybody. Can you hear me? Yes?
Yes, sir. Yes.
Okay, fantastic. All right. First and foremost, thank you, sir, for the generous introduction. And I want to thank the Ramaya Institute of Management for giving me a chance to share some information on time series analysis. So in finance, most of the data we analyze, and particularly I have worked with, is on the secondary front. And you need some very sophisticated tools for data analysis and presentation if you were to write some good papers in Scopus type of journals. So this session you will get some input from me on time series analysis, particularly the econometrics angle, where today most of the well-published data and the work is being done with the help of time series analysis. So let's get into it. I will just share my screen now. All right, so let's get into it. So in time series analysis, why time series analysis? And why is it so popular? So time series analysis looks at anything that varies over time. So in finance in particular, a lot of asset classes vary over time. And time series analysis is very, very useful to study relationships between asset classes, intermarket relationships, forecasting. All these things can be done with time series analysis. So if you look at data, you can, in finance, you can have several types of data. You can have something called cross-sectional data, which is looking at observations at a particular reference point, right? You can also have time series data, which we will talk about quite a bit. You can also have panel data. Time series data, of course, varies with time. Panel data is a combination of cross-sectional and time series. So we will look at analysis of time series, but the tool I'm going to use, which is GRETL, which is a free tool, is able to do all kinds of financial analysis, including panel data analysis, etc. Okay, so what is time series data? So time series data that has been collected over and varies over different time periods. Yes. So you can have daily, weekly, monthly time points. Yes. So stocks, commodity prices, all these things, asset classes, different key asset classes, they all vary over time. You can see below the Nifty chart over the last 10 years, and that is a time series plot, yes, of the Nifty. So what are the types of analysis that you can do with time series analysis? Today, we're going to get into some introductory aspects of time series analysis, but there are many forms of time series analysis which you can do. There is the univariate analysis, which involves just one variable. You can look at ARIMA, ARCH and GARCH models. ARIMA models for forecasting single variables from historical data, right? You can look at also volatility. So let's say there are some studies that have come out in literature which looks at the day of the effect in the stock market. So which day is very volatile? So how can you do that? For that, you can use ARCH and GARCH, volatility estimation of time series. You can use multivariate time series analysis. So you can look at short and long run relationships in multivariate analysis. In short run relationships, you can look at something called Granger Causality, which we will talk about in this session. You can also look at ARDL models, autoregressive distributive lag models. And then on the long run relationships, you can look at co-integration. Are two asset classes co-integrated with each other? What are the implications? And when you have a co-integrated series, you typically estimate that through a vector error correction model or VECM. So we'll briefly look at that. Okay. If there are any questions, please do stop me and ask them right away so I can clarify.
Rajveer sir, just one clarification that GRETL downloading is not done by the participants. Do they have to do it now or you'll be taking them through later?
They can do it now.
Sir, you are mute. Yeah, is that instructions also going to be shared now, sir? Or
shared in the first day. So
GRETL also is shared?
Yeah, the link Praveen sir showed in his PPT had the GRETL download link.
I hope all the participants have downloaded it. If not, they have to do it now, no, sir?
Yeah, I can share the link. Do you want me to share the GRETL link?
Better, sir. Now, many would have not downloaded.
Okay.
Yes, sir.
Let me see.
Sir, by any chance, have you shared any worksheet also, sir?
Yes, one data sheet was also circulated through the Zoom chat on the first day. I'll share all of that now.
Okay, sir. Yeah, it will be better if it is shared now. Yeah.
So, okay, so the GRETL download screen I'm just sending you.
So you can even put it in the chat box. That's not a problem. Yeah.
I just sent it.
Yes, sir. Yes, sir.
You can see this right here, that's 64-bit EXE. That's the latest release. You can download that. Yeah. Then let me also add the data files. Okay, this is the data set we are going to be working with today. So I'm just going to send it. Have the participants received it in the chat?
Yes, sir. Just received the
Yeah,
data
yeah.
sheet. Thank you, sir.
Yeah. Thank you, sir.
So that's all you should need. But please go ahead and install the GRETL package on your system. For our faculty, it is already on the server. So you can just click the GRETL icon on the server, right? If that is not there, you can go through this link. And if you have your own laptops, please go through this link and download it. It will take all but 2 or 3 minutes for you to install it. Okay.
I'm switching to the audio. Just a second.
Yes. So all of you have those 2 links I sent, right? The data set and the GRETL link. Yes. Are you hearing me? Yes.
Yes, sir.
Yes,
Thank
sir.
you,
Yes.
sir.
Oh, yeah,
Yes.
Okay. Okay.
Thank you,
Fantastic. Fantastic. Thank you. Okay. Now, one of the conditions that for analyzing time series data is the concept of stationarity. Okay. What is this concept? You cannot analyze time series unless it is stationary or transformed to a stationary state. A stationary condition implies that the mean, variance, and any other statistical property of the variables stays constant over time. So you need to ensure that that happens, right? It doesn't matter if the variable is not stationary. You can transform it. You can log difference, or you can take a first difference, and you can turn a non-stationary series into a stationary series. And hence it is a very, very important thing to do. So I already showed you the time series plot of the Nifty. This is the time series plot. So the Nifty itself is not stationary. A stationary series will look something like this. Okay, so these are log returns of the Nifty. Yes. So you can see how there is not much variation around the mean, right? It's it's not in a trending exponential rising fashion, right? So a stationary series will look like this, where the mean, variance, and etc. and other statistical properties of the series are constant. Okay, so how can you do check for stationarity? So there is a test named as the augmented Dickey-Fuller test. The null hypothesis of this test is set at the series as a unit root or non-stationary. So if you run the augmented Dickey-Fuller test on any series, yes, and check the augmented Dickey-Fuller test, and if you get evidence for the alternate hypothesis, then the data is stationary. So we'll do that, all of that. So now I will go back to the GRETL screen. Yes, once you has everybody installed it? You will see an icon like this.
Yes, sir, we have installed.
Okay, thank you. And when you click it, a screen like this opens. Yes? All of you have installed and clicked the screen to get a menu like this?
Yes.
Yes? Everyone?
Yes, sir.
Okay, great. So now we are going to open our data sheet, which is an Excel. So you go File, Open Data. Wherever that file you put, you just go there. In this case, I'll go to my folder. This is where I've put. And in the down menu, you see GRETL data files. Please change that to all files. Sir. Yes? It's not speaking. It's just open the change this drop down.
So please repeat once.
Okay, 1 minute. Yeah. I'll show you again. All files, last one. So you just click file. Yes. Open data set. Then go to the path where this is and then just click FDP sample, the file I just sent. You'll get something like this. Do you get? So file, open data, user file. Yes, are you with me on the path? Is everybody
Yes,
able
sir.
to see this? Yes, no?
Sir, getting an error, sir.
What is it saying, sir? Shouldn't get errors, sir. You just go file, open data, user file. Yes? This is the menu you want to use. Is everybody going through this path?
Yes, sir, got it.
Okay. So you go to user file and on the drop down menu in the rightmost corner, you choose all files. In this menu, there are so many menus. Go all the way down and go to all files and you will see your file in wherever the location is. Wherever you save that file, it will be there. Yes? So have you opened it? Yes, no?
So I'm still getting an error, sir.
Sir, are you clicking this file, fdp data sample.xlr?
Yes. I'm clicking on the file. It's already come.
Okay. If it has come, then no issues, sir.
If I click open, it shows error.
No, but do you see this menu there? Nifty, IT, Nifty, Bank Nifty.
No. That's what I'm getting error. When I click on that, I get an error.
Click on the all files.
Okay, sir. Try again.
Okay, otherwise I'll see your president. No problem, sir.
Yes, sir. I can probably give you probably offline. Maybe I can help you out. Maybe in the break sometime. But everybody else is able to open this.
I'm not able to see the file. I saved it.
Okay. You have to just go file, open, go to the directory in which you save. But in the drop down menu, when you say open, just make sure you put all files. Otherwise, you will not be able to see. The default is set to GDT files. Change that to all files here. Then you will be able to see your file. Yes? Everybody able to see it now? Yes, no? Okay. All right. It's actually a simple file open, that's it. You don't have to copy paste into another file or do anything. You can directly upload Excel files, XLS files, CSV files, and any other file. You can even, if you have eViews documents, you can even open SPSS files, anything. Only thing is you have to specify the file name. It's just like you open a Word doc, no other difference. Only thing is in the menu, down in the drop down menu, you must change this to, I'll do it one more time for anybody who's not. At the bottom you see there, you should make it all files. Then only you can see your files. Otherwise it will only pick up GRETL files. Yes? Is that clear? Okay. All right. So now when I open this file, you will have 3 series. Yes, you'll have 3 series. One is the Nifty IT index for about 2 years worth of data on Nifty IT index. Nifty index and the bank Nifty index. Okay. Now, if I want to run my descriptive statistics on this, yes, so I will right click this, right, and do summary statistics. Yes. So I'm sure descriptive statistics was discussed in the last sessions. Praveen sir had elaborately gone through regression and all those. So if I do that, you right click and hit summary statistics. Are you able to get this output? Yes.
Yes, sir, we got it.
Okay. So there, as you can see, some mean standard deviation data is coming. You can also see something called skewness and kurtosis. Yeah. So what this information will tell you is whether this will fit a normal distribution or not. So based on the input you see, what do you think? You think it will fit a normal distribution? This data?
Sir, we are not able to see your screen. Are you displaying your screen?
Yes.
We are
One
not able to
minute.
see beyond Nifty.
Okay, 1 minute. Why is that not coming?
Share it.
1 minute. Ah, okay. Every time I have to share, I
Yes,
do
yes,
something.
yes, sir.
Oh, is that right? Okay.
Or else you have to share your entire screen.
How to do that, sir? Because I'm running
Yeah.
many commands.
Okay, new screen or your entire screen.
All right, done. Are you able to see that when you right click?
Yeah, now we are able to see.
Yeah. Okay. Thank you. So there you can see. So the skewness and kurtosis of a normal distribution are close to 0. Yes. So if you look here, it is about 0.42 and 0.11. So likely deviation from a normal distribution is there in the Nifty IT index just by looking at the data alone. Okay. Just the Nifty itself. Okay. Now let's look at the Nifty IT index we checked. Can you right click and hit summary statistics? Yes, again, skewness and kurtosis are away from the 0 mark. So deviations from the normal distribution are likely there. So to check, okay, whether there is a true deviation. So we all know that stock prices do not follow normal distributions, only stock price returns do. Okay, so this doesn't surprise me. So now you go variable and you do something called the normality test. Yes. Can you see the output of the normality test? Yes. So the normality test, all of them, Shapiro-Wilk, Jack-Barra, all of them, the null hypothesis of the normality test is the series is normal. Okay. Okay. So normality, the null hypothesis of all the normality tests states that the series is normal. So in this case, what do you see? You will see the p-values are all less than 0.005. So this suggests the alternate hypothesis is true here, or which means the series is not normal. Okay, did everybody get that? Yes.
Sir, it's not less than 0.05 for Dornick-Hansen test, no, sir?
So the Dornick-Hansen test, it is less than 0.05, sir. It is power 10 to the power minus 6. So way below 0.
Okay.
So in all those cases, less than 0.
Okay.
So we're getting evidence for the alternate hypothesis, which says not normal. Please remember, in the normality test, the null hypothesis is set for normality. Okay. 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 Now, one of the things we have to do, we talked about this condition of stationarity, and we have to check. So before we check for stationarity, let us add a few things. A few things we want to add. So please right click. Yes. Please right click and add difference. Right click on Nifty and add difference. Okay, what this means is I am adding the first difference of the Nifty. I will come and discuss all of this in a bit, but for now, just learn how to use the menu. Yes. Then go to variable, add menu on the top. Can you all see the add menu on the top? You can go and add, you can add logs, you can add log difference. So I'm going to add log difference. So what is log difference of the Nifty is simply the continuously compounded returns of the Nifty. Yes. So as I told you a little while ago, Nifty itself will not be normal, but Nifty returns will be normal. So let us check that. So let us do a log, a normal test on the Nifty. So before that, I want us to click on the other two menus, on the other two variables, Nifty IT, Bank Nifty, and add a difference and a log difference. So go to the add menu, click on Nifty IT, add, okay, add first difference of selected variables, okay, and then add log difference of selected variables. All of you are able to do this, and every time when you add something, please save, otherwise, okay. Please save the menu just in case. You can save it once, but in case you forget, so it's there. So we'll do that for the Bank Nifty also. Add, yes, first difference of selected variables, and add log difference of selected variables. Are all of you able to do that? Yes?
Yes, sir.
Okay, fantastic. All right, so that's the first step. Now let us click on the log difference of the variables and see if we can do our normality test. So variable, yes, normality test. Yes, so in most of the cases you see that the p-value is greater than 0.05 for most cases. Okay, in some cases it is not, but Shapiro-Wilk and Shapiro-Wilk and the Doric-Hansen test, at 1% significance there is normality, but Shapiro-Wilk and the Lilliefors test are clearly showing evidence for normality. Yes, so it's okay. Ultimately, when you make a stationarity, when you make the data stationary, it oftentimes tend to become normal. Yes. So what about the difference? Let us check that and see if the difference is normal. So just click on that variable normality test. If you look at the difference, it is normal. We are getting evidence for the null hypothesis, right? Yes. Is everybody agreeing with me on that? Yes. You must parallelly do, then only you could check. Is everybody getting that? Okay. Okay, now we are going to check for stationarity. Remember the augmented Dickey-Fuller test? Yes, that one checks for stationarity. So we will first check for Nifty IT, or we'll check for Nifty. So variable, go to unit root test, augmented Dickey-Fuller test. Yes. Test for max, in that menu, you should have clicked test down from maximum lag order with constant with trend. Yes. Everybody seeing that menu? And then you say, okay. Now you look at this. So in the augmented Dickey-Fuller test, the null hypothesis is set for non-stationarity, or it says the series as a unit root or non-stationary. So now let us look at Nifty, this output, and let us scroll down. So what do you, just look at the P values. The P values here with constant and without constant are 0.91 something, above 9. So you're getting evidence for the null hypothesis, meaning that the data is not stationary. Prices are never stationary. Okay, that's why we difference them or take log difference. Now let us run the same test for difference of Nifty. So how do we do that? Variable, unit root test, augmented Dickey-Fuller. There are many stationarity tests, but augmented Dickey-Fuller test is one of the most popular. Now we do that and you say, okay. Yes. And what do you see? P value is less than 0.05. You can see here, P value is less than 0.05 to the power minus 15 here also. So what do we get here? Evidence for stationarity. We can do the same for log difference of Nifty also. Variable, unit root test, augmented Dickey-Fuller test. And I say, okay. So P value once again, power minus 15, minus 17, way below 0, very close to 0 rather, not below 0, very close to 0. So hence, the differenced series is stationary. So remember in time series analysis, one of the things we have to do is if the variable is not stationary, we have to transform it by differencing or taking log difference to make it stationary. And that's what we have done. Is that clear? Yes? Okay, so this is the early part of time series. So we have checked for stationarity, we have differenced the data and kept them ready. Okay. Okay, now some important terminology that you will keep coming across in time series if you read any papers. Level 0, levels. Level 0 means the variable itself. Level 1 or the first difference which we put in GRETL just now. Today's value minus yesterday's value is the first difference. Okay. Log difference is your continuously compounded returns in finance. The continuously compounded principle is often used in option pricing, etc. So it is nothing but ln Pn by Pn minus 1. Where Pn is today's price, Pn minus 1 is yesterday's price. And lags is past value. So this terminology you must keep in mind because this will repeat itself in time series analysis. Okay. Okay, so now we will get into univariate time series analysis. And we will look at ARIMA modeling. So the goal for us to do is to forecast the Nifty using ARIMA model. Okay, so ARIMA modeling basically is looking at past values and trying to forecast today's price. So it is called auto-regressive integrated moving average. Yes, so it is a univariate approach to forecasting. Yeah, so there are two components. One is the auto-regressive part, which is looking at past lags of the variables or the past data of the variables. And then the moving average. Moving average of what? The error terms of the variables. Okay. And the ARIMA model is typically given in a PDQ form. P is equal to the lags of the variable. Q is the lags of the error term. And D is the number of times you have to difference the data to make it stationary. So as you know, in Nifty, when we difference the data, what happened? The first difference itself, it was stationary. So typically your D value will be 1. So now we have to estimate the value of PDQ. Yes. And how do we do that? So the value of D is obtained from the augmented Dickey-Fuller test. So how many times you difference the data to make it stationary? Yes. Then we will, to find P and Q, we will use the auto and partial autocorrelation functions. Yes. Then once you get the wave, the PQ initial values, we will refine the values using AIC values. Then we will estimate the model and we will forecast. Is that fine? Okay, so now let's get into it and see if we can come up with the ARIMA model. I will show you how to forecast the Nifty. You can apply it to the others. Okay, so in this case, so let us look at the Nifty. We already know, we checked the augmented Dickey-Fuller test. Nifty was not stationary at levels, meaning Nifty is not stationary in itself. But first difference of Nifty is stationary. We just ran the augmented Dickey-Fuller test. So in this case, in the ARIMA D value, PDQ, D value is 1. Okay. Now, how do I find the P and Q values? So let me click Nifty. Yes. Right click and do parallelogram. Click on parallelogram. Is everybody able to do that? Yes? Yes, no? So if you do that, it's okay. Just click OK. Look at the graph that you get. The first one is the autocorrelation function. The second one is the partial autocorrelation function for Nifty. So when the autocorrelation function is showing a declining trend like that, it is suggesting to start the value of P at 1. It doesn't mean the final value of P is 1. We have to start the modeling taking a value of P at 1. Okay. Is that fine? Everybody understood that? Can you see that declining trend in the plot? On the top plot, autocorrelation function plot. Yes, no?
Yes, sir, we can see.
Yeah. So it means we'll start the value of P at 1. Now looking at the bottom plot, again you can see there is just one spike and then it's all dissipated, right? That means the partial autocorrelation function is suggesting a value of 1 for Q to start. So we know D is 1 and now we know P and Q we are going to start at 1 and we are going to start the model. Is that clear? Yes, I'm going to start the ARIMA model by looking for a ARIMA 1-1 model. 1-1-1-1 model. Why is that? We had to difference the data once to make it stationary. So D is 1. ACF is showing a declining trend with the highest bar being at the first one. So we will start the ACF P value at 1 and Q value has just 1. The PACF is showing a big spike and then dissipation. So it is suggesting to start the modeling at 1. 1-1-1. It is suggesting we should try an ARIMA 1-1-1-1-1 model first. So now let us do just that. So you go to model, univariate time series, ARIMA. Yes. So we will use Nifty is what we just did. Okay. And what did we say? P value has already come as 1 by default. This is the D values in the middle that I will make it as 1. Include a constant and exact maximum likelihood. No. And P and Q values by default come as 1. So we have also from the ACF and PACF plot determined them to be at 1. And the D value is 1. Now we say okay, and you'll get your ARIMA model.
Sir, quick question.
Yes, sir.
You have taken non-seasonal because you already differenced the data, right? You made it stationary. That's why you have taken the non-seasonal selection.
Yes, yes. I have assumed that there is no seasonality. Okay. However, sometimes some companies' stock prices may be seasonal according to demands in their orders. So ice cream companies may experience seasonality in the summer.
Yes.
Then we will go for a seasonal model. Otherwise, we will stick with the default non-seasonal model.
Okay. Thank you, sir.
Okay. So when I do this, I get a model like this. Yes. Can you see it? Yes. Are you able to see the screen? I'll just broaden it. Yeah. So if you look, the PHI value is the autoregressive component. The phi value there is the autoregressive component. The theta value there is the error term component. So two components, as I said, autoregressive, moving average. Phi value is the previous value, and theta value is the moving average component. And if you look, what do you see? The values are not significant. The p values are all greater than 0.05. So this model is not good. Is everybody following? If you look at the coefficients, you will see that the p values are greater than 0.05. The constant is okay, but the moving average and the regressive component, the model coefficients are not significant. So we have to look for another model. So how can we do that? We will increase the p value to 2 from 1. So also look at this AKAK criterion. This is called AIC. Yes, AIC criteria. So this value is about 2072. So we will refine the model and see if the next model has a lower AIC value. Ideally, you use AIC values to select the best model. But since the coefficients are not significant here, what are we going to do? We are going to try a new model. So what can I do? I can go to edit and modify model here. And I'm just going to change the ARP value. AR is your P coefficient to 2. Okay. And I'm going to say, okay. Yes. Again, if you see, the model is not significant. Yes. So we have to keep on trying till we get a significant model, until the AIC values drop. Okay. So if you look, the variables are still not significant. So we will modify the model again. Modify the model here, and we'll change it to 2 here. Okay. So why it's not clicking?
Okay, it's not coming.
Okay. There we go. So when I change both P and Q values to 2 each and keep the difference in 1, the model has suddenly become significant. Are you seeing that? Yes. Look at the P values. The P values are all significant. So the right model is an ARIMA 212 model. So there are basically 2 moving average terms, 2 lag values, and then 2 autoregressive terms and 2 moving average terms. So this is our final model. Now, how do I write this model? Okay. So I'll show you how to write the syntax from this. The first 2 are the previous lagged values. Okay. So let us write the ARIMA model here. So you will write the ARIMA model. Before we write it, let me make a few inferences here. You can see the AIC value has come down now from 2072 to 2064, suggesting that the model fit has improved. The R square has also gone up to almost 0.97. So this model is reasonably good. Okay. All right. So now let us write this model. How do we write this? This phi 1 and phi 2 are the autoregressive terms. The theta 1 and theta 2 are the moving average terms. So the ARIMA model is going to be written as the constant, which is 16 point. I'll just copy this. Constant. Yes. Plus, I'll just copy the values first. So Nifty, this is the way we write. Nifty today's value is equal to the constant plus the coefficient of yesterday's Nifty value. So we will denote that as Nifty minus 1 minus the previous day's value Nifty minus 2. Minus 1 should be in the subscript. This should be Nifty minus 2. Now we have to write the error terms, moving average terms. Go back here. Just copy the coefficient there. Minus. So minus lags of the error term. So in this case, it is ER minus 1 plus lag 2 of the error term, second lag of the error. So this is how we write the model from the coefficients. So I should actually make this superscript, subscript. Where is that? Yeah, that's how it should be actually. Otherwise it sounds a bit confusing. So Nifty lag 1 and lag 2 and the error term lag 1 and lag 2. So this is an ARIMA 2-1-2 model we have fit. We started with a 1-1-1 model based on the ACF and PACF plots, and we have refined it to a 2-1-2 model. Why we are convinced this model is appropriate? Because the values are significant and the AIC values are dropped. Is that clear? So this is our final ARIMA model. Okay. Now, how can we forecast? Ultimately, we are interested in getting forecasts. Yes. So how can we forecast using this model? So let us look at that. Before that, let me just say. We can run some tests to further validate this model to see if this model is okay. So you can run something called the normality of the residuals. Can you see the residuals are normal? So always you have to do some kind of residual analysis to see if the residuals are normal. So the normality test, what is the default? Null hypothesis. Null hypothesis means the series is normal. So in this case, the p-value, as you can see on your screen, is greater than 0.05. So our residuals are normal, which means the model is okay. Yes. We can also look at something called arch. Arch will just check if there is too much volatility in the time series. Okay, so if you look, the null hypothesis of the arch test says there is no arch effect. This is just on the side, but it's good to run these things. And the alternate hypothesis says there is arch effect. So in this case, you get support for the null hypothesis as the p-value is greater than 0.05. So no arch effect is present. So we are happy. So the model is good. So now we can use this model, yes, to generate forecasts. Okay. So I already wrote the model down. So let's use it and generate some forecasts. So we will go to analysis, forecast. It asked how many observations to add. Yes. So we can add, let us say, 5 observations or 6 observations. I say, okay. It's not clicking. Okay. So now you see, so predicted and actual values. Okay. So you can see the predicted and actual values are pretty close to each other. Yes. And in fact, it even gives you a graph and it shows you where the predicted and the actual values are. Is that clear? You can actually save these graphs, etc., and add them to your work if you want to publish them, etc. So this is the forecast and the actual. Is that clear? Yes? No?
Sir, could you show this forecasting again?
Yes, ma'am. Yes. So you go to the model where your model screen is. Yes. This is the final model, the 212 model, which we refined our screen to. You have this, ma'am?
Yeah, sir, I got this.
Yeah. So just go to analysis. Yes. And you do forecast. And you just do automatic forecast. It's okay. And you say, okay. Analysis, forecast. Okay. That's it.
Got it, sir. Got it. Thank you.
So is everybody getting that? So you can see forecasted values are pretty good because the model is very good in this case. The residuals are normal, no arch effect. R square was 0.97. So obviously the model is good and you can see on the graph how closely it has tracked the actual price. Any questions? No questions? Okay. So in that case, I'll go to the next topic. So the next topic, we are going to look at short-run relationships. Okay. There's a concept called Granger Causality. Please understand, remember, you would have run correlation regression analysis before. Just because there is correlation, it doesn't imply there is causality. So to study causality, we are going to look at something called Granger Causality. Ultimately, it is part of something called the vector autoregression. We will use that template and we will do Granger Causality. So what is Granger Causality? So a variable x is set to Granger cos y if the past values of x help in forecasting the values of y in addition to the past values of y itself. So the lags of x, meaning the previous values of x and the previous value of y, if the previous values of x help in forecasting y in addition to the previous values of y, then we can have something called Granger causality. Or in other words, if x is going to improve the forecastability of y then you can say that X Granger causes Y. So we can have unidirectional or bidirectional Granger causality. Yes, both X and Y must be stationary. So how do we make the variable stationary? By differencing them. Yes, either plain difference or you can do log difference. Yes. So basically, if something is not stationary, after you do differencing, then you can do log difference. Usually differencing will make the variable stationary. Yes. Then we will use the var format. The null hypothesis of the Granger causality test is set at no Granger causality. Meaning, if we get evidence for the alternate hypothesis, we will get Granger causality. Okay. So now let us go back to that GRETL sheet. So we will close all the other windows. So we have already added the first difference and log differences of all the variables. If you have not done that, please do by just clicking on the variable and saying add difference, first difference. Because this is very important. Please note, for Granger causality, the variables must be stationary. So we cannot take the variables directly. We have to difference them. So that's why we have taken the first difference. Now, the next thing we have to do is how many past values are we looking at? Usually, Granger causality will look only at one or two lagged values. But there's a way you can actually do that. So if we go to model, multivariate time series. Is everybody there? Multivariate time series. Go to model, click multivariate time series, var lag selection. Can you click? And on the endogenous variable side, add differenced nifty, differenced d nifty, sir, it's not clicking properly. This one, yes, same thing. I don't know why. So I do that. It has to be the green arrow should click. Ah, there you go. D nifty IT. Double click, usually it should come. So it's not working.
I think sharing the screen now because of that. So just use this one, sir. I mean, touchpad. Use the touchpad and check. Select.
Yeah, it's sometimes it comes, sometimes it doesn't. So click, so the endogenous variables, click your dependent variables first. So we'll make d nifty the dependent variable. One second. Yes. Screen sharing is not working. Why it's not doing it? Okay. Okay.
This variable is not going. Full screen. Full screen.
Is it okay? Yeah, full screen, right?
Yes.
Okay. So there was a little bit of a computer freeze here, so I just reloaded it. Okay. D nifty IT. Are you seeing how I've added the endogenous variable? By the way, what is an endogenous variable?
Dependent variable, dependent.
Correct, correct. So dependent variable which can be influenced by any other variable is endogenous. So in this case, all the variables are endogenous because they will be impacted by something or other. So we will add D Nifty as our first variable, that is a dependent variable, and we will we'll do one at a time. Let us just remove the Bank Nifty one. And the maximum var lag selection, maximum lag order is 24. Let us look at this. So what I'm going to do is I want to find out how many prior observations I must include. Okay. All right. So, and I'm going to say, okay. And if you look, there's a star mark on under the AIC and BIC values. Do you see that? It suggests that the number of lags to take is 1. I typically like AIC values, but all three in this case, AIC, BIC, HQC indicators, Hannaquin, these are all model selection parameters. So they are all saying just use 1 lag. So only one past observation is required. So now we will estimate the and check if there is Granger causality. Okay. So now we will close this. We know we have to put only 1 lag. So we will go to multivariate time series and vector autoregression. And we'll have to change the lag order to 1. So you will get 2 equations. Always click robust standard errors. So what robust standard errors does is it eliminates problems like heteroscedasticity, helps in bringing down. There is a condition called heteroscedasticity with a regression, which Praveen sir must have discussed yesterday. So this can impact, if there are a lot of outliers in your data, you can end up with heteroscedasticity, and that can affect your model. So always click robust standard errors. Now we do OK. And what do you see? You get 2 sets of equations. So how do we know if Granger causality has happened, is there or not? The only thing we will check is that there are 2 sets of equations which have come up here. Yes. Just scroll down and look at that p-value here. Yes. What do you see is the p-value? Greater than 0.05 or less than? Yes. Greater. So that means the null hypothesis of no Granger causality holds in this case. Yes. So when Nifty IT returns, do not Granger cause Nifty returns. Now look back, remember, Granger causality is unique, vector autoregression is unique because it looks at both sides. Now let's look at if Nifty Granger causes Nifty IT. Scroll down to the p-value. What do you see here? P-value is again greater than 0.05. So the null hypothesis is proven. So both Nifty and Nifty IT index do not Granger cause each other. Other things to note, Durbin-Watson statistics is a very important thing. That is looking at something called autocorrelation. Okay, it should be close to 2 for no autocorrelation. In this case, there's no autocorrelation, so we are happy, very close to 2. If it gets near 4, there is negative autocorrelation. If it gets near 0, it has got positive autocorrelation. So in this case, we are happy that the Durbin-Watson is thing, but there is no Granger causality as the p-value is greater than 0.05. Also look at on top, there is something called a Portman-TU test. Do you see that? That is a test for serial correlation. The null hypothesis of that test says no serial correlation. So if you look at the p-value, which is in the bracket, it's greater than 0.05. Right? So there is no serial correlation. So our analysis is okay here, right? There is no autocorrelation, no serial correlation. So the analysis is fine. Only thing is there is no Granger causality, which is okay, right? Yeah. Any questions? So if there is no Granger causality, what does that imply? There is no short-run relationship between the IT index and the Nifty index. Okay. Okay. So now let us check one more thing. Let us check for the Bank Nifty model First, we will try and do our lags and see VAR lag selection. So I will remove Nifty IT and I will, again, that problem has come. Sir.
Can you close this one and open this one?
So model, multivariate time series, bar lag selection. I just want to. This normally if I click this and I say that, it should go that side. I don't know why it's freezing.
This laptop, this gretel is not working properly.
Yeah. Maybe I'll do it on that one itself. Shall I check on that?
Gretel, does it take too long to install?
It's already installed.
It's already there.
You have to just.
We are using this laptop. That system.
Gretel's not running properly on this one. Yesterday we installed.
Is it? How to open
the check in the downloads? Just a second, please. We are just installing it on another computer. It's not letting me. Okay. Yeah. Okay. Just click it. Okay. Stop sharing there.
Yeah.
Yeah.
And share the screen.
Yeah. Okay. So now we'll continue and check Granger causality for the second one. So we'll go multivariate time series, vector autoregression, or multivariate time series. multivariate lag selection. Okay, so we will check whether there is Granger causality between Nifty, IT, the different series. Remember, we have to add stationary series. D Nifty and D Bank Nifty. Okay, and I do var lag selection, and when I do that again, you see the first lag is what the AIC, BIC, HQC criteria picks up. So we'll run Granger causality with one lag alone. So model, multivariate time series, and we choose vector autoregression, and we'll have to change the lag order to 1. Is everybody hearing me? You're hearing me? Yes? So now what do you see? Then I use one lag. Again, look at the p-values. P-value is 0.68 here. Yes? Go down. P-value is 0.1. So again, we don't have any Granger causality between these Nifty and Bank Nifty. So there is no short-run relationship between these variables for the period study. So no Granger causality as the p-values are greater than 0.05. Any questions? Okay. Now, there is one more concept which I want to introduce. We've looked at the short-run relationship. We've looked at forecasting on univariate time form. How about long-term relationships? For that, we will look at something called co-integration. Okay, so co-integration looks at a long-run relationship between the variables. But in the case of co-integration, the variables should be non-stationary at level. So as you know, Nifty is non-stationary at level, right? Only at the first difference, we've made it stationary. Yes. And when do you see co-integration? The two series are co-integrated if they are non-stationary at level, which we know all the three indices, Nifty, Nifty IT, Nifty Bank, are all non-stationary at levels, and residuals of the co-integrating regression are stationary. Okay, so there is something called a co-integration regression that will happen when we test for co-integration. The residuals of that should be stationary. The variables themselves should not be stationary at levels, but the residuals of these variables should be stationary. Yes, so now let us use, there are two popular approaches, Engel-Granger and Johansson's co-integration. Yes, we will use the Engel-Granger test. And then if the variables are found to be co-integrated, there is a long-term relationship between the variables. And that relationship can be estimated through a VECM model, which stands for Vector Error Correction Model. Now let's look at if there is any co-integration. Remember, co-integration should be run at levels itself, non-stationary series. So first let us check for co-integration between the variables Nifty and Nifty IT. So I'll go to model, multivariate time series. Co-integration, Engel-Granger. So here I want to remove the D Nifty, I don't want that. And D Bank Nifty, I don't want that. I want Nifty directly. Please note, and again you have to put test for maximum order. So when I run Engel-Granger co-integration, it is going to first do the Dickey-Fuller test for the variables, then do the co-integration variables. So let us do, first we will do Nifty. and Nifty IT. And say okay. What do you see here? First part is the Dickey-Fuller test, which we already did. You would obviously get p-values greater than 0.05, yeah, 0.626 here. For each of those variables, Nifty and Nifty IT. You can see the full screen. Let me put it. It's okay. Now you go to the co-integrating regression. Remember, the residuals of this co-integration regression must be stationary if there is to be co-integration. So let's look at the rest. So if you go down, look at that. Are the residuals stationary? What do you think? Yes, no?
Yes, sir.
Yes, no? You look at the p-value. The p-value is greater than 0.05, 0.9949, which means they are not stationary. Right? We wanted p-value to be less than 0.05 of the co-integrating regression. So there is no co-integration. Yes, if this p-value was less than 0.05, p-value of the co-integrating regression, if it was less than 0.05, then there is evidence of co-integration. So for Nifty and Nifty IT index for this time period, there is no Granger causality. There is no short-run relationship between the variables, and there is no co-integration as well. Is that clear? Yes, no? Okay, now let us check the same thing for Nifty and Nifty Bank Nifty. Okay. So how do I do that? Model, multivariate time series. Let me look at chat. Let's see. Please do ask me any questions if you have then and there, because sometimes when we go and come back. Okay. So my variable, model, multivariate time series, co-integration, Engel Granger test. So I will remove Nifty IT and put Bank. Remember, we are using the level series here itself. For co-integration, we will always run the series at level, not the difference series. Okay. Test with maximum lag order, click that. Test with constant, okay, and we say okay. Now have a look. As expected, the first part is the Dickey-Fuller test. The variables are not stationary at level, which is okay, which is one condition for co-integration. Yes, p-values are greater than 0.05. There it is there. What about the co-integration residuals? Look at the augmented Dickey-Fuller test. And look at the p-value here. P-value is less than 0.05. Yes, 0.0004 it is. Can you see it? Yes. So this is an evidence for co-integration. How can we say the series are co-integrated? The variables are not stationary at levels. Of course, they are stationary at first difference. The variables are not stationary at level, but the co-integrating equation residuals are stationary, which is a condition for co-integration. Both conditions should be present. So now we can see that our variables are co-integrated. Yes? Okay. Do you need a break now? Or shall I finish up? Participants, do you need a break?
Break for 5 minutes, sir.
Yeah, sure. Please take a break for 5 minutes. In the meanwhile, any questions you can ask, no problem. Please do take a break for 5 minutes.
The fun is working fine. Yes, yes. Video. Video. Discussion videos.
Sir, what is the difference between that short-run analysis and long-term analysis?
Yes, sir. So in the short run, there may be relationships that exist. So for example, the crude price might be impacting the stock market only in the short run.
Okay.
However,
Okay.
in the long run, there may not be a relationship.
Okay.
So very short term effect, but in some cases you may have a long run effect, but you may not have a short run effect.
Okay.
So if there's a short run effect, that means it may disappear within few weeks to months. It may not be consistent. But when there's a long run relationship like co-integrated, there's always a very strong relationship over the long run, say multi years, 3 year, 5 year, 6 year period. There is a long run.
Yeah. Thanks.
Sure.
I think with these tests that are there available in the softwares, I think it is making enabling the even researchers also to understand how the market is behaving.
Yes, sir. Yes.
Yeah. The predictability can be made it easier.
Yes. Actually,
Made it.
I'm showing a few things.
Yeah.
So if you take the data set given to you was only for 2 years.
Okay.
So if you have longer period of data, say 5, 10 years, then these relationships will become more meaningful to forecast and stuff.
Yeah. I think that's
Yes.
why once that Robert Schiller says he took that housing for almost 100 years of data and able
Correct.
to predict that housing collapse, so bubble.
Yes.
I think that
Yes.
helps him. Yeah.
Yes. So in fact, he was the Nobel Prize winning economist who came up with the concept Schiller PE. So he says, don't look at the PE ratio of stocks and say they are undervalued or overvalued,
Yes.
but look at a seasonally adjusted PE ratio,
Okay.
cyclically adjusted PE ratio. So that way you take the economic cycle also into hand.
Okay.
So
that's
that's
seasonalities. Yeah. Cyclical.
Yeah. Correct. So it's very interesting.
Okay. I think that's a wonderful area where I think we can get a lot of research.
Yeah. A lot of such. So today with the cryptocurrencies and all being there, so cryptocurrencies are thought to be leading the market. So are they going to lead the market? So
yes.
Yeah, Bitcoin crashed around 50% from its highs, $62,000 to $30,000 recently.
Yeah.
So typically, there is a thought process that after 1 month, maybe it will translate into other risky assets falling like stocks also.
Okay.
So this type of relationships you can study and predict.
Oh yes, absolutely. It went up to some $65,000. Now it is some $40,000. I think that variances we can monitor. Yeah.
Yes.
Thank you, sir.
Sure. Okay, I'll just finish up with this. Now that we know that there's a co-integration between Nifty and Bank Nifty, what we can do is we will look at an error correction model to estimate the relationship. So I'll show you how to do that. So we go to the main menu. We'll go to model, multivariate time series. In this case, we will not choose any of these. We'll choose VECM. Why we are choosing VECM? Because the relationship was co-integrated. If there is no co-integration, we will choose vector autoregression. Please remember that. If there is no co-integration, but if there is Granger causality, then we will choose vector autoregression. If there is co-integration, we will choose VECM. So we'll choose VECM. So what is VECM? VECM is nothing but an error correction model. So it is very similar to the vector autoregression model, but it will put an error correction term to account for the co-integration. Okay. So I will just click that and I will change the lag order to 2, because sometimes what happens is the default is set to exclude the variable. Even though we put the variables, sometimes it will exclude the independent variables. So we will change the lag order to 2. Yes, rank is 1, no problem. Yeah. No exo. By the way, any idea what exogenous variables are? We already discussed endogenous. So
Yes, they are
exogenous,
independent. Yeah, independent variables.
totally independent. Nothing should impact them.
Okay.
So ideally, you don't have too many, but you can have these variables you create, which are called dummy variables.
Okay.
So dummy variables, which are given zeros and ones, they are typically your exogenous variables. Okay, so now let us run this. Let us run this. And I will do okay here. So as you look, you will get two models. The variables we already know are co-integrated, and you will get models like this. Yes. So the first equation is D Nifty as a function of D Nifty 1, D bank. See, automatically it is putting D Nifty, the difference series. Even you did not indicate it, but the error correction model is put. So you should always start with the level series, the co-integration approach. Durbin Watson is 2. We are happy with that. Can look at the portmanteau test. Sometimes it may come. In this case, it is not there, but not necessary here. So this is our two-way vector error correction model, Nifty, Bank Nifty, and Nifty. So how do we write this model? Difference Nifty equals constant plus difference Nifty with a lag 1, difference Nifty bank Nifty with a lag 1, and the error correction term to account for the co-integrate. Remember, the VECM and VA are two-way, so you will also get the other equation, not only y a function of x, x a function of y. So Bank Nifty, okay. All right, great. Now, some interesting things you can do here. So let's say I want to forecast the Nifty, maybe. So I'll do analysis, and I'll do forecast. And I'll say I can choose forecast either Nifty or Bank Nifty. So this is the beauty of multivariate time series. You can forecast both variables, one and from each other and depending on each other. So I'll say Nifty. So I'll say I want to put 5 here. They do that. You can see this forecast will be much better than your traditional regression forecast. You can see how close the forecast and actual values are. Yes, much better than the earlier ARIMA model, even though, right? Almost, you can see very close they are. Yeah, forecasted and actual values. And these are the forecasted values for the next 5 years. You can go 5 data points. We can go back and check how accurate they are. They are reasonably accurate, the VECM models. Yes. Another thing you can very interestingly do in the VECM model, which I really like, is impulse response. What happens if there is a shock in the Bank Nifty? How will it impact Nifty? So let us look at that response of Nifty to Bank Nifty. And I say, okay. Have a look at this, very interesting. Yes? So if you look at this, where did I keep that? Response of Nifty to Bank Nifty. So initially, when there's a shock to Bank Nifty, yes, after 1 week, yes, what happens is there is a shock in Nifty also. So if Nifty goes down, Bank Nifty goes down, in the first week, Nifty also goes down. But later, have a look, it recovers, and in fact, it goes back up again. So this shock only lasts, even though this is a long-run relationship we are seeing, the shocks don't last for more than 1 week. There is a shock, it lasts for 1 week. After that, nobody. Now let's look the other way too. What about Bank Nifty? How is Bank Nifty responding to shock in Nifty? Go under graphs, response of Bank Nifty to Nifty. Say the same thing again. Have a look. So initially, yes, there is actually a rise. Yes. So Bank Nifty initially, when Nifty goes down, it is suggestive of rise and then it starts coming down. Yes, so knee-jerk reaction is a small rise initially, and then after 2 weeks it starts coming down. So this type of relationship you can predict. So markets do have shocks. COVID-19 was a very big shock, right? So these two markets are more related to each other, Bank Nifty and Nifty. But what if you take gold or crude? Then you will get some really relevant information here. And this type of analysis can be used to study how shocks in the economy can impact the stock market, which I think is very, very, very useful. Any questions? Any questions?
So just to show that navigation,
Any
how
questions
you
on any aspects discussed?
so how did you get this response of Nifty to Bank Nifty?
I will just show you one more thing, the diagnostic tests, which are very, very important. In time series, one of the things you want to know is to understand whether your data is stable. Okay. So for that, what we can do is we will just look at an OLS and 3 tests. So we'll look at ordinary least squares here. We will look at Nifty, D-Nifty, difference Nifty. We cannot, why sir, it's not again clicking.
There is a lag in response.
Yeah. This one. Which I should?
No, yeah, this one.
This only?
Yes.
When that you connected, it went.
There was some disturbance in the audio.
Okay. D Nifty, and we will run D Bank Nifty. And I will always. No. Okay, D Nifty. And D Bank Nifty. No, sir. This also is not clicking. Let's see, remove this computer is some disturbances. Nothing close. Okay, now it comes. And I'll click robust standard errors. Again, something.
There was some disturbance here, so I just.
Okay, now I do this. And I do a simple OLS. So you get this. Now, how do I know my parameters are stable? So there are some diagnostic tests you can do. The first one is the Chow test. What the Chow test does is it checks for structural breaks. So because of some outliers in the data, suddenly COVID may have changed the economy. Is the data structure still remaining the same or not? So that is the Chow test. So I'll do that. It will split the data into 2 points and check if the test, if your data is stable. So the null hypothesis is that the parameter is stable. The alternate hypothesis is parameters are not stable or unstable. So what do you see? The p-value? P-value is supporting null hypothesis, which means it is stable. The null hypothesis of the Chow test is saying the data structure is stable. So, and there is no structural break. So we are happy with that. There is no structural break in the data. P-value greater than 0.05. So our data is stable. Okay. Another test you can do is the QLR test. Again, yes, this is again looking for structural break. Same thing as the Chow test. It will confirm what the Chow test saw. So no structural break. If you look, the null hypothesis says no structural break. The alternative hypothesis says there is a structural break. So evidence is there. P-value is greater than 0.05. Evidence is there for no structural break, which is the null hypothesis. Okay. Then there are two more tests. One is the CUSUM test, cumulative sum test, which is looking to see if your constant term in your regression is stable or not. So here too, the parameters are stable is the null hypothesis, and the parameters are not stable is the alternate hypothesis. Go down, just check the p-value. P-value greater than 0.05, we get evidence for the null hypothesis. The parameters are stable. So our assumptions so far, so good. And also you'll get a graph like this. If the green line is in between those two parameters, then we are stable. So we are stable. So this is looking at the constant of the regression term, right? To check everything. How about the slope and the intercept? For that, we can look at the CUSUM square test. Okay. So this also is suggestive of stable. This is looking at slope or coefficient, and it is also looking at the error terms. So if I look at that, again, you can see the p-value will be coming somewhere down. So it's between the two ranges, so it is stable. So null hypothesis, no change in parameters, which is what we want, no structural break. So we get evidence for the null hypothesis in both cases. So this is it for time series. Well, this is not it actually. I've given you the basics of time series. There is one more thing called Garch and Arch. That is only to estimate volatility. If your series is extremely volatile, then you can look for Garch and Arch. In this case, the series, we looked at the Arch effect and it was not that pronounced. So there is no relevance for that. But you can look at that in case you want to do volatility assessment of a time series and particularly check when the market is volatile and when it is not, then you can use the Garch and Arch approach as well. So this is time series in a brief 2-hour nutshell. Do you have any questions? I can go back and show you tests that I have done because there's still a few minutes left. Any questions?
Yeah, so the Garch model for volatility, right?
Yes.
So you check if the volatility is there, and does it also help to make things stationary and help in forecasting, or you just assess the volatility and stop there?
No, that is only to forecast volatility.
Only forecast.
So I can forecast how the volatility is changing over time. So typically the problem with time series is it assumes that constant volatility is stationary assumption, which may not be the case. Like in COVID, the volatility of the Indian Nifty index went from the Nifty VIX went from something like 12 to 80.
Yeah.
So that is completely non-linear exponential increase in volatility.
Yep.
So when that happens, how can you model that in a traditional time series approach? It won't work.
True.
So you must use Garch or Arch for that.
Got it. Thank you.
Sure.
So in all these cases, p-value has come more than 0.05, right?
Yes, sir.
Okay, that means we always go.
So
that is considered in the assumption itself?
Yes, the tests are built in such a manner, sir.
Okay.
So the default of the test says the null hypothesis is no structural break. So given that we are getting evidence for the null hypothesis, we are happy that there is no structural break. However, if there is a structural break, then you have to split the data set and treat it separately. Or you must transform the data in such a manner that there is no structural break. Either way.
Okay.
So all these diagnostic tests will confirm that your more time series model is actually worth good. In addition to all those parameters like R square, Durbin, Watson, etc., you also need to do a few diagnostic tests to tell people that your data structure was actually pretty good.
Yes.
Because sometimes if there is a structural break, then your data analysis may not be valid because the market behavior may be different in different periods.
Yeah. Yeah. Understood. Yes.
So the best thing to do is get weekly data for at least 10 years. Then you have very good basis for your analysis.
Yes.
Daily data is not good because of the holiday effect.
Yes. In between. Yeah.
So you may have
Absolutely.
Diwali here, market may be closed here, but market may be open in the US.
US. Yeah.
So weekly data solves that problem. Any other questions on anything analysis, any form of analysis we discussed here or anything you want? So GRETL is a free tool. eViews is a purchase-based tool. So given the functionality, GRETL can do everything in eViews. People say sometimes they are very familiar with eViews, but not many people are aware of GRETL, but this is a free tool and there's a very active discussion forum that goes on where a lot of these guys from top universities in the world are giving input. So this is the latest version that came out. There is also a user manual by Professor Lee Atkins of Oklahoma State University, where he goes through a lot of these GRETL commands. Please note, I have showed you a menu-based command. There is also a coding-based command available in GRETL if you want to do that. I never got into it, but I really like GRETL compared to R because the coding element was not here. And for somebody like me, it was a menu-based approach always works because it is easy for me to understand. But there are a lot of engineers who know Python who can also do the coding. And they
Yeah, I saw that in the last one attended workshop. They showed Python.
Yes, sir. Yes.
To analyze this, financial markets, but
yes.
You should be knowing coding. That is
yes,
yeah.
yes. Which unfortunately I don't. But
Yeah,
GRETL can pretty much do many of the things that any other software can do.
Yes.
And it is free. So
Which is the book you mentioned, sir? Lee Atkins?
Lee Atkins GRETL user manual. If you just search GRETL manual, Lee Adkins.
Okay.
So almost 300, 400 pages. All these tests are discussed. And he's also given, you can go to his website also, he's given a lot of sample data sets also. Any other questions? If there are any follow-up questions, of course, our faculty can always come and discuss with me. We can discuss. Anybody else, the outside participants can please mail me if there is any issues, any doubts, or you can even call me in case you need it. So in GRETL, you can also look at all the time series plots, etc. You can just go to a variable, any variable you want to look at the time series plot, just right click on it and just do time series plot. You'll get the graph. So GRETL does a lot of things. You can download this and insert it. It does make paper writing a lot easier. Visually, a lot of graphs you can create, a lot of things, charts, etc. Any other questions? If not, I will close the session little early, maybe 5 minutes early. Okay, thank you very much.
Thank you, sir. Thank you, sir. Maybe it takes some time for us to get that,
Yes, sir.
similarity with the navigation.
Yes. And daily
Done with the
practice
job.
about 1 or 2 hours
Yeah, that helps in
with the
regular
data
easy.
sets. Then you will discover a lot of shortcomings which you will investigate and fix.
Yes.
That's how I've been doing.
Yes, thank you, sir. I think that's the best method.
Yes.
Yes, thank you.
Thank you so much. Silent. Thank you, sir.
Thank you, sir. Thank you very much, sir.
Thank you, sir.